G'day everyone, welcome back to Money in the Tank episode 62. We are short one man down today, one good man down. We've got two good men in place. We've got myself, Joel Seach, Principal Advisor, Harpel FG, and it's an easy one today. I throw to that way.
Left or right? Brad Tabone, investor and generalist.
Great to be
Jolly.
Thanks, mate. Great to be with you. Great to be back with the Tankers today. We've got a great episode lined up today to touch on all things finance related to help you guys get a better general in nature understanding of what's going on in the marketplace when we talk about money, because it's one of those topics that may not come to air that often. So we like to make it an easy understand approach for you guys to help work through your money management side of things, but also just to get a bit of an overview and understand what's going on around the world in easy to understand language, which we hope we're able to provide to you. So if you're new to the pod, that's what we do. And topics today, Brad. So we've got a few things that we'll cover off. A couple of things from me, I guess, will be, the interest rate hold that we had the start of this month, I should say, start of April. So the RBA. We'll touch a little bit on the property market and what's been going on here domestically in Australia. And then you've got a few points you want to touch on as well, Brad.
Yeah, so the IMF report, global report came out, I think it's in the last 4 or 5 days, let's just say. So there's touch on the global stuff. Some global indicators and kind of what their forecasts and thoughts are around that, and some silver lining. Good to see some silver linings and positive stuff. Then the IMF reports around Australia and construction property, so I think we'll touch on property there. No doubt some people have heard around the BRIC. So the BRIC reserve currency, it's kind of been spammed all over YouTube and the news around kind of, the death of the US dollar. Give my thoughts there. And kind of gold and BTC and Bitcoin have taken off. So thought we'd also jump in and kind of have a look at what's happened to gold and Bitcoin over the last kind of few months.
They're back.
Pretty interesting to actually see gold over the last 10, 15 years. I've got a graph, which is interesting. And thrown in there, I've got some the Bloomberg 12 indicators as well, just so we can compare kind of some indicators that kind of I look at and what the IMF is, and kind of give that global picture. And for the listeners can kind of understand, the plethora or variety of different indicators and why they're important but not important at the same time, because they're just that, an indicator to kind of the financial health of both domestic Australia and what's going on internationally. So Big Jolly, over to you for a bit of Rifkin's, mate.
Good data points, plenty of data, and we're on
plenty of data.
Rifkin's is generally not data driven. It's usually just random facts from Rifkin's book. So here we are here, page 72 of Rifkin's rules. In a negotiation, always wait for the other party to make its position clear first.
If you can.
If you can, which is a fascinating, it's always an interesting one, because you could have extremely long and awkward silences when no one says anything, and the first to break loses is generally what they say.
I think that's almost like a mandatory part of that awkward silence, and it's so from experience, I think, is that you're just happy to sit there in that awkward silence and not be filling the room with noise. So you have to kind of learn how to do price negotiations in the US with companies, I can tell you that much.
And you got 2 ears to listen with and 1 mouth to talk with, so sometimes it's better to use the 2 ears to listen. So don't mind that one from Riv, old school negotiation tactics. So
101.
Let the other person talk first, or break first, or tell you what they want first, and it might be better than what you were hoping. So on to, I guess, starting off maybe with the latest RBA rates, which are not so late now, but
2 seconds, mate. I'll just bring that up for those on YouTube. Letting you know, for those that are listening to us and no visual, just bringing up an ABC article, because today we're going to be touching on a lot of articles. So an ABC article that goes through. Is that loud and clear there, Jolly?
Yeah, so it's general in nature as always, but it's always good to give the audience what they want. So when we're talking about the Reserve Bank, so the Reserve Bank, as we can see from the article there with Brad and some of the information I've got here, is the 4th of April. They decided to leave the cash target rate unchanged at 3.6%. So and the decision, I guess, was after a cumulative, I think they had 10 rate rises in a row, so 3.5 percentage points since May of last year. So it's been every single month apart from January, where they don't meet, that they raised. So The board sort of talked about, and I guess an interesting tidbit with the RBA is they don't need to actually explain much if they don't move, but they've talked a bit about it here, as they recognise that monetary policy, which is the tightening or easing of the interest rates, operates with a lag. So, and the full effect of the substantial increase interest rates is yet to be felt. So they're taking the position to hold the interest rates steady this month and provide additional time to assess the impact. So they're waiting to see what the impact looks like. And they noted there that global inflation remains really high. But they said in headline terms it is moderating or cooling. So, but services price inflation remains high in a lot of economies. So the outlook for the global also, remains subdued, but it'll also come into play as to how, I guess, we shape up here from a interest rate perspective or a monetary policy perspective. So, but there's forecast to be below average growth globally in the next year and two. So, yeah, it's an interesting one, because there was a lot of pundits out there that was saying that they were going to raise rates. I think it was about a 50-50 maybe, and I was at an economist briefing that day, and the economist said he was expecting a raise, and then that afternoon it ended up being a no raise, no move. So, and now you're starting to see a little bit of stuff come out, like from the big banks, to say there could be potential cuts by the end of the year, which is fascinating how quickly it's gone up, and then to talk now of cuts maybe coming towards the back end of 23, which the banks sometimes have some pretty good information that comes through there as to what they're seeing from a savings scenario and a lending scenario and a cash flow scenario. So it's time will tell as to how it goes. But yeah, first rate hold, and then I guess we'll be interesting to see the next month's meeting, which will be the first Tuesday of May, as to whether they maintain that stance of wait and see approach, or whether they do have another raise. So I'm chatting to people regularly, and some say that they think there'll be one more raise to come, but some are saying, like I think myself, I'm sort of in the camp that I reckon they're going to wait and see a little bit more now. Brad, what do you reckon?
Yeah, look, I think that the global banking, so some of the failures in Europe and the US of kind of big banks, obviously some of them being bought out or forced to be bought out, like UBS and Credit Suisse, or the failure of SVB and a bunch of others, have kind of given pause to a lot of these central banks in terms of how fast they have risen. Also, I think the situation of mortgages, which we'll cover off in an IMF report around property and around construction, especially in Australia. I think due to our high home ownership in Australia and mortgage stress for at least, let's just say 20% of the population from kind of missed mortgage payments. This was going all the way back to January, February, so it would even probably be my guess. It's only a guess. Is more now. Probably not getting better at the moment. I think it's a prudent decision after 10 in a row. 10 in a row is, some might say too much, some might say not fast enough. It was interesting just with the RBA coming out this week saying that they've done a pretty poor job, which is quite interesting in terms of managing and giving borrowers expectations of no rate rises really till 2024 and then 2023 over the last 12-18 months, and getting them in this position where there's obviously been 10 in a row. So I think it's prudent. Whether it becomes permanent or not, I think depends on how sticky inflation is. Out of the US, I think was one I just pulled up then. Just kind of was interested in seeing. So I know that the US CPI numbers, not that Australia and the US are the same economy, but at least kind of getting a bit of an idea around. So I know that New Zealand raised rates recently. The US latest CPI report came out on the 12th of April, and consumer price index rose 0.1% in March. The core accelerated. So I think it was in line with largely what people were thinking around, kind of settling around that 5 mark at the moment, being a bit sticky. but the core, which excludes food and energy, accelerated 0.4 to 5.6%. So I think it's going to just be interesting to see what happens with the economy, see if is there any more failures in construction, failures in banking? Is there any sort of risk coming in? What does the mortgage stress book look like? What do auto loans look like?
There's so many factors that move into it. It's a perpetual in motion moving, mixture of different levers that'll come into how all this unfolds and how it plays out. And even yesterday, I think I noted a data feed came in from the unemployment rate in Australia was still relatively low, and they were expecting it to loosen a bit, but it still remains tight. So that's a factor against interest rates kind of staying low. If unemployment rate remains tight, then that's sort of a sign that the economy is still too strong. They like to have a bit of unemployment in there, but it's also
it's horrible to hear. Like, it's horrible. Yeah. It's horrible to actually think that they I saw that the labor numbers came in stronger than planned, and suddenly futures everything turned. You're like, in the past, strong unemployment numbers were a sign of a healthy economy. But in the current scheme of things, it's like the economy's still firing too much. So inflation's going to be too high.
Governments try to play their political campaigns off on, low unemployment and getting people jobs, and now they're like, there's the job market's too tight, and people's wage growth inflation is pushing too much, and they don't want that, so they're wanting that to subdue and ease off a bit. But it is a very tight landscape for jobs out there. There's a lot of there's sort of a ratio of jobs available and people that want the jobs or need the jobs. It's too tight, so it pushes that business to be able to have to pay more to get that employee, because we're such a tight employment environment, and that's probably lag effect from COVID-19 and whatnot. So we've got to see that loosen off a touch, and that's that's one of those levers that's going to come into play with how the interest rates end up coming out in the wash.
Yeah, kind of one other point that was made, who it was over last week, just stuck with me. It was just an interesting point, whether it's true or not. Another reason why they're targeting kind of that 4 to 5% unemployment rate in the States, and I think 4 to 5 here is a bit of a healthier sign, is also which sounds disgusting as well, which is also to do with kind of capitalism and inflation. And because inflation's been going for a while now, you've got a number of companies that are actually taking advantage of supply shocks and inflation shocks, and are continually just raising prices at the moment, and getting used to just raising prices 5-8% year on year, even if they haven't necessarily, like, say, their input costs haven't gone up 5-8%, they're able just to charge and make more profit. So there's record profits and record revenue occurring within these companies at the moment. They're saying it's a sign of capitalism and the situation we've got at the moment. And so by moving unemployment and spending up to that amount, they think it's going to start countering that and start enforcing things back this way, like what's happening in, say, the auto market in America at the moment, where, I just got an email the other day from Carvana, which is a company that buys cars, and my Merc, when I was over in the US, actually went up in value. So I bought 2018, 2021, it went from 44 up to 51, which is kind of weird for a 2016 Merc. So I sold it, and that's gone now from 51 down to 34 in the past 18 months, because kind of that ability for both the new car market to charge above MSRP, and then the secondary market to follow the new car market due to supply shocks and logistics. You had people carrying on this kind of MSRP thing, and now it's kind of biting them the other way, because you've got auto loan failures, you've got people that don't have being able to repay it, etc., etc. So look, it is swings and roundabouts. But I think interesting one to kind of just watch what's happening kind of overseas and here, and I think a prudent decision.
Price takers and price makers. So yeah, there's companies out there that can make the price and set the price, and people are willing to pay for it. And then there's markets out there like the car market you said, where they can set the price if they want to set it high, but they just won't sell any cars because the takers aren't going to pay for that. But yeah, there's companies out there that are more proofed in regards to they can set a price, and people are generally going to deal with it. Like Adobe, for example. I got an Adobe bill the other day that had gone up, well above inflation. It's like, well, probably going to keep Adobe.
Well, inelastic, right? So price elasticity, and it's a hard one. Yeah. It's like hosting costs on like Amazon for our business. It's like, you get a new Amazon bill, and it's like, Amazon bill, price has gone up by 33%. You're like, well, I'm not going to move our entire product infrastructure off Amazon. But, maybe 3-4 years in a row, and if there was competitiveness and the rest of it, you start making plans. But there's some things that you're just going to just pay, and they know it.
That's a price maker.
It is a price maker. All right. So IMF report. Let me just get that one up. And again, for those just listening, just bringing up some visuals around the latest World Economic Forum's IMF's outlook. So you see that one loud and clear, Joel?
Absolutely.
Awesome. So just some started going to some data and some information. So, but I'll run through it and then throw to you, Jolly, and get your opinion on it. So the IMF new economic world outlook predicts that growth will fall to 2.8% from 3.4% in 2022. Global inflation will continue to decrease this year, but decline will play out much more slowly than originally expected. Which I thought this was an interesting one, with inflation above the national target for 97% of economies. Stronger multilateral cooperation across all facets, and we'll go into why they're saying that, because I think there's a bit of a I think we talked about in the last podcast, a bit of a value set blocks of trading partners that are starting to form, and we'll talk about that around the BRIC stuff as well. And so some of the key points they talk about and why they're kind of revising growth outlooks down is around what we talked about before, around regional banks in America collapsing and the takeover of Credit Suisse by UBS. I think, continue the war in Ukraine and what's kind of happening there. It looks like it's going to ratchet up with a bit of a spring offensive. This is looking now at a graph which is growth outlook, feeble and uneven, and this is just looking at the world advanced economies and emerging economies. Obviously, growth in the emerging economies have gone from about 6-7% in 2021, stabilizing around that kind of 4 to 4.5%, and the advanced economies, which Australia is a part of, again, growing around that 5% in 2021, which is way too fast for generally historical advanced economies, and dropping down around the 1.5% mark. And so that's kind of, dropping down to that amount from here, where we are in 2023, and really just flatlining out to 2025, which I thought kind of interesting, that they're kind of thinking that we're going to be in this kind of storm, rough and tough thing, working out stuff, de-hedging a whole bunch of stuff, unwinding a whole bunch of stuff. I think they're what the key takeout here for me was, buckle in a little bit. It's not necessarily going to get a lot worse, but there is going to be these things that come up, like the banking failures and the all sorts of stuff like construction failures and the rest of it. It's just the unwinding. Things aren't catastrophic, but there is going to be some bumps, and it's not going to be come out necessarily rosy anytime soon. I'll stop there. Jolie, any thoughts before I continue?
Yeah, I think that's relatively what we'd expected from the easing of policy that we had during COVID to now realizing that everyone had gone too far, and they're worried then about inflation, which had ramped right up, and inflation is not good for anyone, or rampant inflation, and they've had to really go hard to bring that back down and get that GDP figure back down again. So I think the graph on there illustrates it really well for anyone that's listening. If you jumped onto YouTube to check it out, it sort of shows a few different graphs as to where we're going, where the expectation is for growth to come back, and it will take a little while to unwind. Which inflation, it can take a while to unwind, but you definitely don't want sticky inflation where it's hanging around year after year.
Yeah, I think the next figure that I thought was interesting was just their assumptions and forecasts around monetary and physical policy stances. So that's when we start looking at, what is the cash rate for the central banks. This is only looking at the United States, the Euro area, and Japan. Obviously, Japan's just flat line there at zero. Not much movement there over the last 20, 25 years. But, the United States and Europe, it's kind of looking at peaking kind of either where we are today or, towards the back end of this year, and then slowly coming off and coming back down to that kind of stable 2.5% cash rate all the way out in 2026. They're kind of saying 2-3 years for growth to come back, 2-3 years for kind of interest rates to come back down, and then the inflation coming down over time. They're all saying that it's peaked, headline inflation, and they're all calling out that core inflation has probably peaked as well. And this is the world advanced economies and emerging market economies. And it is going to take kind of, all the way out to 2025, 26 to get back in within the kind of the targets, which is those dashed lines there for emerging economies, advanced economies, and the world.
And just for the listeners out there, you got headline inflation and core inflation. There's a little graphic there, and there's a note like core inflation excludes volatile food and energy prices. So it's a method used to get a better idea to what inflation's truly at, as opposed to factoring everything in that can be very, very volatile at times. If there's big supply shocks, for example, with energy, it can really skew the numbers. That's why they like to look at core inflation.
Correct. And again, it looks like, in line with when the economy will probably start getting a bit rosy again, and when interest rates will settle down, you're probably, buckling in for at least, a good 24 months. But we should start to see some big changes, from 8% core inflation, and, 7% across the world down to, in 2024, down to half of that. So, as long as it is going to take at least around a bit longer than expected. Now, again, anything can change these things. These are just forecasts, and individual countries can be different. And this is just looking at trading blocks of the world and emerging economies versus advanced economies. But it just gives a bit of an idea around, what headwinds and things we're heading into. I think one of the key things for me was the silver lining. The last point on this bit, which was the fog around the world's economy outlook may be thickening, but the IMF does still spot a silver lining among the clouds. The unrest in the banking sector, it says, is likely to slow lending, which could help to cool inflation and remove some of the need for higher interest rates.
Glass half full action, Brad.
Yeah, a bit of different for me. Glass half full. There was obviously when SVB was we had Lightning Partners, which is an investment bank that we've selected, or the part of the selection process for Hamatech over from the States last week. And these guys run with against your Houlihan Lokey's, your Goldman Sachs, these kind of investment banks, and interesting just chatting to them for a week, and they were just talking about how when the SVB thing happened over that weekend, and then it looked like First Republic was going, and you said Silver, they had Credit Suisse in trouble and the rest of it. They said that basically it looked like another credit freeze between interbank transfers, because obviously the banking system is all built on trust that a bank's going to be able to pay another bank back, and especially with their short-term lending and liquidity. They said that the difference this time is that there seems to be a lot of lessons learned from 2007, 2008 GFC around how that can literally just, and so the injections and even the buyout and the rest of it of securing the deposits, etc., but not necessarily the buyout out of SVB and actually letting it fail, kind of made to do this, where they said there could have easily been another Lehman moment. And again, we never know. We've all got our own opinions on this sort of stuff, and some contrarians will say, we're just kicking the can down the road and the rest of it. But it is interesting to see how quickly we could have just been up for another moment where credit freezes, interbank transfer of money freezes, no more loans, etc. But I think I like this one a bit more, which is glass half full jolly, which is
well, it's good that they've learned from the past, essentially, which is which is really nice. So I think one of the I listened to an episode on I think I've spoke about it before, Planet Money Economist podcast, and talked about the safety net for banks and the discount window in terms of the Federal Reserve helping out these banks during this period. And it's a fascinating look back at how the last 100 years of banking has gone and how they've kind of adjusted and tweaked how they kind of bring in a tool such as the discount window in terms of lending money to banks that are in a tough predicament, but not lending it too cheaply so that it's just an easy out for banks to get capital injections, but lending it at an amount where it's okay, well, you're still paying a decent amount of interest, but it almost got tarnished with this brush that if any bank went to the Federal Reserve for this help, they got immediately kind of lambasted or looked down upon from their peers for it. So they've had to tweak and adjust how that looks for banks, and they even spoke about some of the bigger banks kind of I guess them leading the charge in terms of we'll use these Federal Reserve funds and we'll be leading the charge. So then the other second and third tier banks can come in and not look so bad doing it. So it's a real fascinating history and look back, and it does seem.
Where did you hear that, mate? I'm really interested. Where did you hear that one?
So that one for the listeners out there is called the NPR Planet Money podcast.
Love NPR.
And it spoke about the safety net for banks, and it sort of does a look back of the last 100 odd years of how it's all transformed over the period of time, and then more recently the GFC into now and what they've learned about that. So it's quite an interesting listen. So I recommend you jump onto it.
I think we mentioned about 4 or 5 weeks ago, and one of my glass half full things is that at least we've been through. Like, you're always learning new things. Like this bond market one will be something that they remember in the future, that if you raise rates too fast, bond markets can get impacted, that they didn't think about it. It's just like with the Lehman one where they let it go and they're like, okay, well, let's not save it. And then they saw the ramifications of that. So they twist, and then you say, then there's the dirtiness of kind of what it is to kind of ask the central bank for help. And if you did that, then you're gone instantly. Your share price is gone because it means government takeover. And I think that's
no one was using it. No banks were using it, so they're like, "We've got this thing here to help," but no banks, because it was tarnished with this bad brush. So
but if you used it, then I love there's that side of human nature, which I do love, because a lot of people believe in history repeats itself and the rest of it, whereas history never actually, like, there's definitely patterns and human nature, but we are creatures that do learn. And so there is that. Not saying that we're not going to learn ourselves into a big hole. It's just that it's never going to be the same. I thought I'll jump into the IMF ones now, Joel. So give me 1 second.
IMF Australia.
IMF Australia.
Yeah.
So key ones here being obviously the title. IMF warns of rocky road ahead. Will Australia slip into recession? International Monetary Fund has released its outlook, and the forecast is bleak. Always a bit of fun. Good at media. So Australia's GDP is expected to grow by 1.6% in 2023, followed by 1.7%. Despite bleak outlook, Treasurer Jim Chalmers is confident Australia will avoid recession. And the state of the economy will largely depend on the RBA's cash rate decisions. A bit of a handball there, I think, because I think there's some fiscal stuff that the government can get involved in. So we have the predicted growth in GDP 2022 3.7, 2023 1.6, 2024 1.7. I think like you talked about before, Joel, that we're better placed than most countries to be kind of testing the rate rises and the rest of it, and trying to get inflation under wraps as quickly as possible due to our low unemployment. And because of the price we've been getting for our exports, again, this is something that helped us out during the GFC, which is the price of our kind of, we've got like a two-lever economy. So one is obviously services and the other one is mining. the mining and the exports have been kind of helping out a lot. The IMF is saying that, you know, it is stubbornly high, our inflation. That rent is a big problem. So the continued rent rises in Australia are due to supply and demand not necessarily matching up. I think we're still at our record low. If you can fact check me if there are any listeners out there, but I think we're still at record low amount of rental properties available in the major capital cities, at least on the east coast of Australia. I know that the government put in a new low income housing, so they put about 10 billion away over the next 8 years to spend building housing, but they said the gap is somewhere between 40 and 50 billion, which is you know, slightly more than the 10 that they're committing.
Yeah, it's a real predicament, I guess, from a rental perspective in Australia and the property side of things, which we mentioned at the start of the podcast, that, you know, the property market's held quite tightly here, and the supply has really gone down. So it's starting to see that because the supply is not there, and this is from a property sale perspective, that the actual growth for the first quarter is largely positive in most states, if not all. I think I read this morning that Sydney was up 0.8 for the first quarter, Melbourne 0.2, Perth I think another 0.1, Brisbane a little bit more. So that's sort of the market we're in from a property perspective. But the rental thing is a different it's a different equation altogether. That's a medium to long term ingrained issue that we've had, and it's only been exacerbated more since the reforms came in, I think circa 2017, where for some reason, you know, the media started playing out against landlords, and then the banks started changing the way they lend to landlords. Different state governments started to put in these different rules around what landlords can and can't do. So landlords are essentially just investors. There might be mums and dads investors that have one property. There might be someone that has a few, whatever it might be. But their role is as an investor, is to get an outcome on an investment, which in this case it's residential Australian property, and get a return on that money to help them, you know, get ahead from a wealth position, whether it be for retirement or whatever else. But, you know, they're doing that, and the byproduct of that is it's a supply to the rental market of Australia, and there's always going to be a rental market in Australia, and there always has been, there always will be. I think I read some stat the other day that 1 in 3 people have rented during their lifetime, and that probably won't change too much. It may even get more.
Not all.
So there's a big issue and a big gap in the Australian market from a rental perspective, and that stems back from years of bad policy decisions, which has then disincentivized property investors to either want to get into an investment, or may have even worse, they've sold the investment, and that's then not been taken up as another investment property. It's now maybe someone's principal place of residence. That's then supply off the market. Factor that in with, we've probably had about 4 or 5 million population growth the past, 5-6 years now in Australia. So you've then got less rental supply with a higher population growth demand, and I think it's only about 4 or 5% of rental accommodation or accommodation is public housing, is supplied by the government. The other 95% is private individual investors. So if you're disincentivizing those people, what magic happens? Where you get heightened rates of rental increases, you get homelessness, you get people sleeping in cars, in caravans. But but the government's just like, they've got their head in the sand if they think $10 billion is going to do it. It's an ingrained issue, and they've disincentivized investors that supplied all these people. So they've really got themselves to blame, and it's a big wake-up call to someone, that hopefully someone realises it in Parliament one day, that we might have made a bit of an error here. So, we'll see where it all comes.
I think another point, and I was having this conversation with someone during the week, I think one thing that a lot of people also forget is a lot of the laws that were changed around foreign investment. Yep. So back when housing prices were, I think it was 2000, and I'm going to say 2016 to 18, somewhere around there, there was a lot of pressure with, housing prices. This is before the latest growth spurt, and, international ownership pushing up the housing prices. And so not just an increase on stamp duties for international owners, but a lot of rules came in construction. And I know that a lot of Hamatex clients, being the kind of, the 80%, 85% of the big commercial builders in Australia, and having chats with them, they all said this is going to come bite Australia in the arse in 5 years, the next 4 or 5 years, because some of the laws changed where they couldn't pre-sell part of. So not only have they been disenfranchising the everyday Australian kind of investor, mum and dad, from buying an investment unit in the city, because there's a lot of the supply issue is to do with units as well and high density housing. Now, so you used to have a building and you could have 70-80% of that building pre-sale within 1 or 2 days, right? And obviously, the downturn in the Chinese economy and the rest would have impacted this anyway. But you've got the downturn in Asian and Chinese economy, where a lot of the buyers came from, mixed with double the stamp duty, mixed with now only 50% of a high-rise building can be sold internationally. The rest has to come from Australian investors. So you used to be able to sell 70-80% and top it up with Australian investors. Now at least 50% of that building has to be. And so then it's just disenfranchised developers from overseas in Singapore and Malaysia and the rest of it to come in and do developments where they knew they could secure from Malaysian, Chinese, Singaporean or Southeast Asian high net wealth investors to come in and actually buy the properties. So they've got disenfranchised Australians and then disenfranchised foreign investment when you've already got a supply issue. I mean, as you said, Joel, head in the sand, and I don't know what we've upticked migration up to 300,000 per year at the moment.
Yeah, so it's just people in government that have, as we said, a head in the sand, but they've got no real idea or concept on how property works and how real market economy works, and they think that they can gloss over it with a band-aid fix of a $10 billion, even that's a lot of money. It's more ingrained in that, and it's going to get worse before it gets better. To be honest, it's a really, really tough environment out there, and some places are worse than others from a homelessness and a rental situation.
Final 2 factors before I kick on. One, have a look at the build-to-rent market in Australia and how that's going to grow, because corporations are seeing the profit they can actually make here. And it's going to head the way that America does with build-to-rent and corporations actually owning and being your landlord, which I can tell you from experience of being over there for 5 years, is not as good as your mum and dad, because the corporation can do anything that they want. There's no competition, right? They just buy the whole building. They own the building. And the second thing is that, as you said, we've got people making decisions, and even if they get good advice, they're making decisions off what the political, because of this, where this, generally the Western political system works, it's all based off short-term things. So if the pariah at the moment is blame international investors for our housing prices, you won't have a government person get advice and say it's actually not them. It's actually, this is systemic, been around for a long time. You need to push back and do the tough thing and just wear the heat, because we need foreign investment. You have politicians that choose the easy route at the time and put these things in place, not for the betterment of the country, but betterment for themselves. That's correct. I'm not going to go political on this show, but it is, some things need to change there. Jolly, I'm putting up a IMF warns Australian housing market, high risk of mortgage defaults ahead of the global economic downturn. So this is the last of the IMF. And just I thought another key one just to kind of talk to. So the level of risk in Australia's housing market is the second highest. And for those just listening, I've got a couple of points here in this report. So the level of risk in Australian housing market is the second highest in the developed world. The International Monetary Fund has warned. Using a range of risk factors, the IMF says Australian households with mortgages are at greater risk of defaulting on mortgage repayments due to higher levels of household debt. Rising interest rates contributing to higher mortgage rates and elevated house prices. And they're basically saying any economy with higher house prices and household debt are particularly vulnerable to stress in the financial sector. So the IMF basically put out a heat map, Joel, you can probably see there. And the highest risk for those that just can't see this is the Canadian market. And so this is across kind of 5 different factors. First factor is C1, which is households' outstanding debt as a percentage of overall disposable income. So we're a red in that one, whereas Canada is still in a yellow, so they've got still a bit of room to go. C2, which is the second column, share of debt outstanding at a variable rate interest. So we're both like bright yellow on that one, heading towards red. Share of, in column 3, share of households owning home with a mortgage. Canada is red. They've got a lot. Australia's about 60%, so we're high yellow. Column 4 is cumulative real house price growth. So again, Australia is high yellow, Canada is red. And the 5th is cumulative policy rate changes. Canada is red, we're high yellow. Just letting you know, we're running in like the Luxembourgs, the Norway, the Swedens of that in the world. So just an interesting, an overall total score, we're red. Same with Canada, Luxembourg, Norway, Sweden, and the Netherlands.
It's a great, interesting table. I'm always mindful of global economist reviews of a niche country in their market. That's the only thing.
Because how much can you take of that, like idiosyncrasies related to that market into play? But I mean, those factors, if you're looking at them, things like disposable income to loan ratios, these sort of things are pretty, you would say, standard risk metrics. They're not necessarily looking at too high a thing. Again, they don't factor in things like supply and demand there, right? So they don't say, what is the supply shortage of new homes? What is the demand? So there's a ton of stuff there, and that's why people are holding on to their houses at the moment, Joel. And new listings, I think we talked about 3-4 episodes, we're down 25% in some areas, 17% nationally.
We haven't even spoken about like new builds, being down, like
new builds down,
being low. So you're not going to get. There's not a lot of supply that's coming on, and then you've got building companies collapsing, like Porter Davis just in the news last week.
Nice segue, Joel. So please continue.
Like we haven't really even touched on Porter Davis, and we've lost a few big builders in Australia now, and it's an interesting conundrum. And I was reading an article about how Porter Davis operated, and they. For the listeners out there,
the concrete slab one, I just found that fascinating, huh?
Yeah, they operated where most builders will operate where they get their profit on the last instalment, so the last tranche of payment from the institution or the person doing the build or paying for the build. But Porter Davis had it up front, so they had the slab poured, let's say a $100,000 slab or an $80,000 slab or 10% of an $800,000 house. They'd get that, and then they take their 10% profit at that stage. So that 80 would turn into 160. So essentially they had their profit margin built into the front end of the contract. They somehow made that legal. I don't know how it is, but they somehow manipulated the system to make it happen. And then they managed to try to get as many slabs as they could get poured over the past period of time to get all that 10% profit built into that front end payment. And then they're now gone into default or bankruptcy, and left a lot of people in the lurch, plus a lot of homes. And I think they were one of the maybe the top 5, top 10 builders in Australia in terms of, or maybe Victoria.
Yeah, yep. I just found it fascinating that they basically charge 80 grand for a slab for actually pouring the slab, and then they charge another 80 grand on top of it, and then they kept 80 of the profit. So whatever the profit margins were, they just dumped on top of the slab and then started pouring slabs everywhere.
There's no incentive for them at the end to get to a finish of a build. The incentive's pretty much gone.
Or a slab.
Paid up front.
And that's the bit they're like totally. But then their whole business model was incentivized against actually like they did nothing. So they were the 12th biggest in the country, and they'll in the top 5 in
Victoria.
Yep. And so this is Henley Homes is an article up for those that are listening. 3 1 in 100-year events. What caused the construction collapse and what happens next? Interesting article. I
love the headline there. I love the old 1 in 100 event, but it's happened 3 times. 1 in 100-year event, but it's happened 3 times. So is it still a 1 in 100?
They're right 60% of the time, all of the time. So is it 1 in 100 or is it 1 in 100 times 1 in 100 times 1 in 100? So actually a lot more. Not very good at mathematics there, John. So this is Anthony Blackshaw, Chief Executive of Australia's 8th largest home builder, Henley Homes. Look, he just discusses here, obviously, pandemic, followed by a whole bunch of people wanting homes with some stimulus coming into it, and then obviously the high logistical problems, followed by home loans, interest rates. So the central bank raises have obviously caused this. He also goes into, talking about kind of that, one of Australia's largest and most respected builders, Porter Davis, collapsed, but then goes into when you actually look behind the scenes, maybe they shouldn't have necessarily been one of the most respected, which is always the interesting ways. Goes on to talk about the other, obviously you had the biggest about 4 months ago, Metricon, but they ended up kind of resolving their cash issues internally. At the moment, the ones to watch is Simmons Group and the Dennis Family Homes. Both have shed 10% of their staff this week, falling sales volumes, rising costs, trade shortages, etc. When he talks about the overall construction sector, he does say that obviously the construction sector in Australia is responsible for 7% of GDP and 9.5% of total employment. But kind of talks about how the housing sector is very different to commercial construction at the moment in the economy. So he thinks that where we've got high population growth, obviously you've got housing and rental affordability concerns, and we need to be looking at this as the area which you talked on, Joel, and we talked on before, but says that the commercial construction is in a much better place than general housing, which is your domestic home builders. And I thought that was kind of interesting because I myself thought, obviously, with a lot of the bigger ones falling down, like PDL in Canberra, you had ABD Group, you've had some of the biggest ones in the country go into commercially. But obviously, with home builders are different for those listeners between why he's stating that the domestic housing market is in a much worse place than commercial right now. It's largely to do with fixed contracts. So houses and your domestic home buildings all lock in generally fixed prices, and that's why they've been hammered with the increase to the supply input costs and labour costs. If you say you're going to build a house for $800,000 and now it's going to cost you $950,000 to build that house, you're losing $150K. You can obviously see why that's a massive problem. They're saying that the commercial builders obviously can go back to the developers, and they've got ways to go through with requests for change and variations and all the rest of it built into the contracts. So a lot of the building companies operate on a 1% to 2% margin, and commercials able to kind of push through that a lot easier than domestic. And one of the last points there is supposedly that there's going to be 106,000 house shortage over the next houses, not apartments, houses, over the next 5 years, 2027 at the moment, Jolly. Thoughts?
Well, that's again an interesting article, and I might get you to send me that one, and maybe we can put it in the show links as well to the podcast, because it's an interesting read, and it hits home being a local, Victorian. So a supply shortage of 100,000 houses to 2027. It's supply demand economics, and it's not a great thing. And we're seeing these building companies go under in an environment when the market should be at its strongest, because the demand for these builders is right up there. It's a fascinating situation which will take a while to unfold. And then I did note in there that the Victorian government has a lot of their own work going on at the moment, which is then taking away trades into the government-funded jobs, which then leaves these residential builders a light on for labour and workforce. So it just pushes costs and timeframes out more and more. So the Victorian government possibly also has a part to play in this, because of their local infrastructure builds that they're doing in an already inflationary environment, and people are going to choose, trades are going to choose where they want to work, what they want to do, and how much they want to get paid.
Yep.
So, yeah.
I think that's interesting. The infrastructure spending one is an interesting one where I remember seeing kind of, would have been a good 3 years ago, what the major infrastructure projects in Australia were. Infrastructure pipeline projects, this one here. It's going to quickly, I digress. And we are going to move the BRICS discussion to next week, because
And we might also do crypto and ether next week as well.
Yeah, we're going to move gold. We're going to move defensive stuff to next week, brick to next week. I just thought I'd quickly throw this one up just because it's in topic, and I think an interesting one on your point there, Joel. Remembered it off my head, which is this one here, which is this is looking all the way out. I think back in like 2016, 17, when basically everyone announced every project under the sun. What we're looking at the moment is a graph that goes from 2006 out to 2023, and the amount of projects going on in Australia, and all the ones in orange here are the ones in the rail projects and the level crossings. So, for instance, the Melbourne Metro tunnels here, level crossing is us. Regional rail revival is us. Inland rail runs through us, but it goes everywhere. The Albion Park bypass. You've got the new connects out to the airport coming up. So there's a whole bunch. You've got obviously the West Gate Bridge tunnel, etc. So this is looking at the amount in billions, I believe, the government is going to be spending year on year, and we're at kind of that peak level at the moment, and it goes for about another 4 or 5 years out. In Victoria, you've got the school, so the all the vertical school projects that are kicking off and have been kicking off for 3 or 4 years now. You've got the Melbourne Metro Rail, which is obviously everywhere and adding 14, 15 stations. You've got the Westgate tunnel, and so massive infrastructure projects like Jolly expect, and they aren't going away.
There's more pain to come, I think, Brad.
Yeah, I think so, Joel. But just giving data points for the listeners, mate. But look, we've talked a lot about that stuff. We'll move the Bloomberg stuff next week, gold BTC next week, brick next week.
Tune in, and we might try and get. I might actually hit my cousin Adam up on to come next week and share his thoughts on where he thinks crypto's going.
Yeah, let's do it.
Been going on. So I know you missed the last one with Adam, so that'll be fun. We'll see if he's around. But in terms of, so Adam, if you're listening, you'll get a text from me today. In terms of the 50-50 this week, it's a 50-50 for myself, actually. I was in the car the other day with my young bloke, and I'm not sure, Brad, whether you indulge every now and then. You go into a chemist, like an Amcal chemist or whatever, and they've got those jelly beans.
Yeah.
Your go-to jelly beans that have been since you're a kid. They're great tasting jelly beans. I reckon they're the best I've ever had. Your textbook Amcal ones, I think they're like blue packaging with
yep.
So anyway, I was thinking today, and the reason 50-50 and what's your choice, you've got a choice of all these different things in life when it comes to investments, but personal life choices too, is what colour jelly bean do you choose? And the random fact here is that my son randomly likes the black ones. And I think there's probably a percentage of the population out there that would agree that he goes for the black ones. He likes the taste of the black, and I'm sure there's
aniseed. Is that aniseed?
Yeah, there's some weirdos out there that love those black ones, and he's one of those weirdos. Whereas I hate the black ones and leave them all in the bag. So purple's my go-to.
That is perfect yin yang though. You and your son, he can eat all the black ones, and you get everything else.
Yeah, absolutely.
You're talking about those glucogel ones that you see in the chemists everywhere, the blue packet, right?
Yeah,
I think they taste so good for all the people that need their quick hit of sugar. Yeah. I'm a pink or purple. Yeah. I go between. That said, I don't mind the remember that white one? I don't even know what it is. I don't know what flavor it is.
White flavor.
Just white. But I'll probably stick between if I could, between the pink and the purple myself.
Love it. So, listeners, keep sending in your 50-50s, any weird selections you've got when it comes to food choices or life choices. We love to hear, and we'd like to put it out to the podcast and the audience as to what their preferences are. But please hit us up. And where can they get us at, Arnie, I should say?
Arnie, where are you? I'll cover Arnie today. You can get us everywhere, basically. So you can get us Spotify, Instagram, Facebook. I've started throwing some stuff onto LinkedIn. Basically anywhere you get a good podcast or visual podcast, you can get us there.
Leave your comments. We'd love to hear from you, and shoot us up, Facebook, Messenger, all those good places. So keep them coming, and we hope you enjoyed the episode today. Sorry, it was a bit of a longer one because we missed last week, so we had a bit more to get through. But as always, we appreciate the listeners coming along, and appreciate your time, Brad. It's great to catch up, and we look forward to releasing our next podcast in the following week to talk a bit more about the current crypto environment and gold prices.
Indeed. All right, all. Have a good one. Bye.
Take care.